Morning students, welcome back to the session on accounting. So today we are going to continue with our discussion on this piece related to reconstruction. Yeah, in the last session, as we were discussing about internal reconstruction, so there were certain aspects of this reconstruction in terms of the accounting requirement, and in terms of reduction of capital that we plan to cover today. Okay, so I'll just straight away move on to the reduction of capital. Yeah. Okay, all of you, if you can just move on to reduction of capital, please. Now, reduction of capital is also one of the mechanisms which the companies may opt in terms of doing their internal restructuring or this internal reorganization. So let's understand what is actually required to be done. If all of you can move to page number 6.9. Now, company may by a special resolution reduce the share capital in the following manner. Extinguish or reduce the liability of the shareholders in respect of unpaid amount on the shares held by them, or paying off any paid up share capital which is in excess of their requirements, cancelling any paid up share capital which is lost or is unrepresented by another or available assets. Generally, this mechanism is resorted to by a company when this has been suffering losses, because its capital is then adjusted against the negative reserves. See, for example, company has got this is the capital of the company, say for example, and it reserves, let's suppose, are negative. So net, what is the position that you see? 7 crore. But you keep getting to see negative reserves. Let us suppose if the company reduces the share capital. So what will happen? When the company will reduce the share capital, these will be adjusted against this negative. Yeah. So this will look bit improved, even though the net assets will remain same, but the balance sheet will look better. Aditya is talking about liquidation. Yes, Aditya will come to liquidation also, but after this. So as you know that some part of this topic is also pending. So that's why we'll wrap it up first of all and then move on to the liquidation. So let's see what are the various steps you will see. When liability of the shareholders is extinguished or reduced in respect of unpaid amount on the shares held by them. In such a case, how do we record it? So this is the situation number 1. Case A. In this situation, the shareholders will not be called upon to pay unpaid amount on the shares held by them in future. For example, a company decides to reduce rupees 10 per share into rupees 7.5 per share fully paid up. And this will be done by cancelling the unpaid amount of rupees 2.5 per share. So let's suppose share was there on which 2.5 was unpaid and this will not be called upon. So in this case, what is the accounting entry that will be passed? Share capital. Currently, this share capital was partly paid up. So we'll say partly paid up. Account debit. Okay, and this was face value into number of shares. And out of the face value, 7.5 was called upon into number of shares. Correct? This was the current position. Now moving further, its share capital will become fully paid up. So we will say to share capital fully paid up account. So this has become fully paid up account. And once again, the total amount of capital will remain same. 7.5 into number of shares. Okay, clear on this? Yeah. Another situation. Situation number B. When excess paid up capital is paid off. When it is not possible for the company to employ profitably its paid up capital, then in such a case, it may decide to refund the excess capital. Let's see an example. Company having fully paid up share of rupees 10 each decides to pay off rupees 2 per share to make it rupees 8 fully paid up. So what would be the entry? Once again, share capital account is debit and it will be for rupees 10. To share capital account of rupees 8 and to sundry shareholders, or you can say to bank account, because rupees 2 on this per share has been paid back. Clear? Next. Situation number C now. So you can just understand please how the capital is getting reduced in each and every scenario. Okay. When the paid up capital which is lost or not represented is cancelled. Let's understand this. Reduction in paid up value only. In this case, let's suppose nominal value of the share, the nominal value in this case remains same and only the paid up value is reduced. For example, shareholders may agree to reduce paid up capital of rupees 100 per share to paid up value of rupees 10 per share. So in this case, what is the amount of sacrifice which the shareholders are doing? Rupees 90 per share. So in this case, once again, what do we do? Share capital account debit to capital reduction. Why do we call it as capital reduction? Because in this case, the capital has been lost. Okay, that has been reduced. That's the sacrifice. Now this capital reduction account is nothing but a nature of reduction of capital. And that's why it is required to be presented separately. Okay. Let's suppose if there is reduction in both nominal and paid up values, then what do we do? Share capital account debit. Let's suppose share was of rupees 100 per share. To share capital, now the share capital will be of rupees 10 per share. To capital reduction account. And what's the capital reduction account? Rupees 90 per share, because 90 per share has been lost. Clear? Yeah. Now what we will do is, we will move on to one illustration wherein we will apply some of these principles we'll not only look at the accounting entries, but we'll also look at the balance sheet. So you can all move on to illustration number 3. Page number 6.11 for the time being, but you can all move on to illustration number 3, please. Mukamala is asking for this explanation of accounting treatment once again. I would suggest that all of you please wait for this illustration to get completed. After we discuss this illustration, most of the things you will be clear on. Okay, so don't worry. Even if you have not understood, this is going to be repeated. Yeah, there are few entries which are given on this page number 6.11. We can just quickly flip through these and then we'll move on to illustration number 3. Yeah. Whenever there is a scheme of internal reconstruction, what are those accounting entries? Let's understand that. In this case, the alteration of share capital and the variation of shareholder rights do not involve opening the capital reduction or reconstruction account. So whenever the share capital is only altered means not reduced, or rights of the shareholders are changed, there are variations. Remember in the last session we discussed about variations in the rights of the shareholders. In those cases, we will not open capital reduction account or reconstruction account, something which we saw in our example on this reduction of capital. Number 2, so all of these steps you can just mark it for your notes also. So you can say point 3 should be your notes. It is only under the reduction of share capital, unrepresented reserves, compromises, arrangements, and surrender of shares, there shall be capital reduction or reconstruction account. Okay. So we can say that there are 5 types of internal reconstruction we discussed. In which type capital reduction account will be opened and in which type it will not be opened is something which is given. Meghna is asking, sir, in what circumstances paid up capital is lost when the capital is reduced? Okay. And the paid up capital is reduced. If you want to note down, you can note down. Aditya, I'll have to come back to your query later on, please. Let's focus on this chapter, please. Number 3, an appreciation in the value of asset or reduction in the amount of liability should be debited to concerned account. Concerned account means that particular asset or liability, and credited to capital reduction account. Number 4, eliminate any debit balance of P&L and all overvaluation of assets by crediting the accounts concerned and debiting the capital reduction account. Means if there is any debit balance or overvaluation of assets, all of them will also go to capital reduction account. For this purpose, any reserve appearing in the books may be used. If any balance is left in capital reduction, it should be transferred to capital reserve account. So we'll see. When we'll solve illustration number 3, we'll see how this is treated. If there is any balance in reconstruction account, it is finally transferred to capital reserve. But if the amount for writing off assets and accumulated assets is more than reconstruction account, then the reserves will be adjusted against the same. While preparing the balance sheet of a restructured company or a reconstructed company, The following points are to be kept in mind, and these are very, very important. You can note down for the purposes of your exam. After the name of the company, the words "and reduced" should be added only if the court so orders. And in case of fixed assets, the amounts written off under the scheme of reconstruction must be shown for 5 years. So this is about disclosure, which are required to be done in certain cases. Okay. And in our situation, in our example, for the purposes of your examination, whenever there is any capital reduction, you should always write "and reduced" in the balance sheet. Okay, and we'll see how this is required to be done. Vijay Shankar is asking about buyback and surrender are the same. No, those are not same. Those are different. Those are governed by different requirements of the law. Surrender is something that we are seeing in this chapter. Buyback is something different. Okay, so now we will move on to illustration number 3, and this is page number 6.12. So let's understand. Balance sheet of A and Company Limited as at 31st December 2000 X1 is as follows. It's given. So you can just flip through the balance sheet. It has got reserves. Reserves are negative. So that means the company has been incurring losses. They have borrowings, payables, overdraft. Then they have got fixed assets, PPE. Then there are current assets and the notes are also given. So this is the format as per schedule 3. Then moving on to the information after the balance sheet. Court approved a scheme of reorganization to take effect on 1st of January 2000 X2, whereby the preference shares to be written down to ₹75 each. Currently, if you look at the preference shares, those are ₹100 each, they will be written down. And equity shares will be written down to ₹2 each. Now, all of these points are important. Of the preference share dividends, which are in arrears, those have not been paid for 4 years, 3/4 should be waived, and equity shares of ₹2 each should be allotted for the remaining quarter. So 3/4 will be waived, and for 1/4 equity shares will be issued. Next, interest payable on debentures will be paid in cash. Debenture holders agreed to take over freehold property. Book value was 1 lakh at a valuation of 1,20,000 in part repayment of their holdings, and to provide additional cash of 1,30,000 secured by a floating charge on company's assets. So they will give more money to the company, against which some more debentures will be issued to them at the rate of 8% per annum. Patents, goodwill should be written off. Inventory written off by 65,000. Remaining will carry. For bad debts, provision should be created. The remaining freehold property means one part has gone to debenture holders. The remaining is required to be revalued. Investments are required to be sold. Directors should accept settlement of their loans as to 90% thereof by allotment of equity shares of ₹2 each, and as to 5% in cash, and the balance 5% being waived. So that should be waived. There were capital commitments totaling 2,50,000. Okay. These contracts are to be cancelled on payment of 5% of the contract price as a penalty. Ignore taxation and the cost of the scheme. These are required to be ignored. You are required to show journal entries in respect of our transactions, including cash transactions, and prepare the balance sheet of the company after giving effect to all of these transactions, or you can say after the completion of the scheme. So there is a restructuring scheme which is written, and this is approved by the court. And this has taken place on 1st of January 2000 X2. And on 31st of December X1, we have the balance sheet available. Correct? So what we should do is, ideally, in the exam, you should not only pass the journal entries, but alongside you should also open the balance sheet. Because some of the adjustments related to balance sheet and the notes to the balance sheet should be prepared simultaneously. See, this approach will generally save your time. Okay, so that's why it's always advisable to follow this approach. But currently, I will not be able to get on with the balance sheet first. I'll have to pass the journal entries, and only after that I'll be able to go to the balance sheet. Okay. So let's move on to the journal entries in the books of A and Company Limited. So in the exam, you should write this input in the books of A and Company Limited. Okay, then of course, date should also be put. So what is the first entry? Preference shares and equity shares are required to be written down. So equity share capital. Now all of these entries will take place on X2, 1st of January X2. Correct? Equity share capital, which was rupees 10 account debited. And what's the amount? It's 7,50,000. To equity share capital, rupees 8 account. And what do we have here? 75,000 into 8. Okay, so what do we get? 6 lakhs. Sorry, this is reduced to 2. So into 2. So this is 1,50,000. To capital reduction. And what would this amount be? 75,000 into 8. This is 6 lakhs. Okay, clear? Yeah. All right. So this is first. Similarly, we will reduce the preference share capital. 6% cumulative preference share capital, and this was 100. Rupees 100 account debit, 4 lakh. Two, 6% cumulative preference share capital, rupees 75 account. And what's the amount that we get? 4,000 into 75. So what's the amount? 3 lakh. 2 capital reduction. 1 lakh. Okay, yeah. And please don't forget to, please don't forget to write the narration. Narration is very important in the exam. Clear? Next, in respect of preference share dividend for 4 years, what's the amount of dividend for 4 years? 6% on 4 lakh. This is, which is in arrear for 4 years, 3/4 should be waived. So that is not accounted for and waived also. So do we see anywhere in the balance sheet preference share dividend for 4 years? No. So that will not get accounted for because this is waived. Mukkamala is asking, sir, what is the underlying meaning of capital reduction? See, its direct meaning. Forget the underlying meaning. Its direct meaning means capital has been reduced. Can you see this? Equity share capital was 7,50,000. Now it's reduced to 1. As simple as this. Okay. Now, in respect of preference share dividend, 1/4 is required to be adjusted. And how do we do this? So if you look at the preference share dividend, this is 4 lakh into 6% into 4 years into 4, and 1/4 part of this into 1/4. So this comes out to 24,000. Now for this, equity shares of ₹2 each will be allotted. So how many shares will be issued then? 12,000 of ₹2 each. Correct? So we will say 2 equity share capital, 24,000, that means 12,000 into 2. And this item is not appearing in the balance sheet, so we'll have to record it, and it's a kind of loss. So where do we take it? Capital reduction account debit 24,000. So this will be adjusted from capital reduction account. Now please try to understand the rationale. In fact, I am now coming to the query of Mukkamala in a way. You remember when the partnership was dissolved, realization account was prepared to settle everything. Yeah? And you remember in case of this amalgamation, etc., when the company was dissolved, once again, the realization account was prepared. Remember? To settle everything or to get completed with that process. Similarly, in respect of this restructuring, which is taking place internally, which involves reduction of capital, a capital account by the name, an account by the name of capital reduction is opened, wherein all of these adjustments will be passed. Okay. Vijay Shankar, I have passed this entry. This is the entry for waiving the preference shares dividend. Okay. Now moving further on to point number 4. Interest payable on debentures is to be paid in cash. So what is the amount of interest? Excuse me. So what's the amount of interest payable on debentures? It's 22,500. So that should be paid in cash. So interest payable on debentures, debit to cash. It's 22,500. Okay. So you can say to cash to bank. It's one and the same. Yeah. Next is about this adjustment related to debenture holders with freehold property. Debenture holders agreed to take over freehold property. Means the freehold property will get reduced. So we can say freehold property debit. Yeah, this will get reduced. Its book value was 1 lakh at a valuation of 1,20,000. This has been valued at 1,20,000. And if you look at freehold property, this is all in all 4,25,000. Yeah. So now on this freehold property, if you see point number 8, it says that the remaining amount of freehold property, so that means 3,25,000, so that will be valued at 3,87,500. So we can see there's a total revaluation gain on freehold property. That should be recorded first of all. This is given in the working mode, but still for your references, I'll tell you. See, 1 lakh has become 1,20,000. And the balance amount, that is 3,25,000. Why? Because only then it becomes 4,25,000, which is there in the balance sheet. This becomes 3,87,500. So all in all, this becomes 5,07,500. Okay, and the difference between these two is what? Difference between these two is 82,500. Yeah. Now this is what? This is an increase. This is an increase in the valuation of freehold property. Okay. So what do we now need to do? Increase the value of freehold property, 82,500, and the impact on this once again will go to capital reduction. $82,500. Aditya is saying, sir, in second entry in the module, only preference share capital is credited, but you credited cumulative because the nature of the preference share capital has not been changed. Yeah, so that's why I've written the same one which was there in the balance sheet. It's one and the same thing. Don't worry. Radha is saying, sir, capital reduction in a sense is just a temporary account being used for showing the assets and liabilities and the reserves which are getting written off. Absolutely right. Akansha is saying, sir, for payment of dividend in entry, why capital reduction account is used? Because as I told you, it's a scheme, it's a process which is going on, and for settlement or for this complete process, a kind of settlement account is prepared, and that is capital reduction. That's why it's moving to capital reduction account. Okay. Now, what is required to be done? Debenture holders need to take over freehold property. So we will say 6% debentures count. 1,20,000 is the value of debentures which will go down to freehold property. 1,20,000 value of freehold property is gone off. Yeah, so this is also reduced. Okay. Then, what's the next step? So this is reduced. Now, debenture holders are paying more cash and more debentures will be issued to them. Bank account gets debited. Why? Because the money will come in and 8% debentures will be issued to the same debenture holders, means to the same persons. But the rate of interest is different. Clear? Next. Now, as around investment, patent, goodwill, inventory, those are required to be written off. So we'll pick it up later on. For the freehold property, we have done the adjustment. Bad debts will pick up later on. So 5, 6, 7, we have not considered. Moving on to point number 9. Investments will be sold at 1,40,000. In the books, investments are appearing at 55,000. So they are getting sold at a profit. Bank debit 1,40,000 to investment 55,000 to capital reduction. So what's the amount? It's the balancing figure 85,000. Okay. Next, point number 10. Point number 10. Mukmala, 3,25,000 is the balance which you receive if you reduce 1 lakh from 4,25,000. In the balance sheet, freehold property is 4,25,000, from which 1 lakh is already considered, so balance is 3,25,000. Shorya is asking, what's the nature of capital reduction account? You can say a temporary account or an account which is used in this process of reconstruction. And this can have any balance. Generally, it will have credit balance. Okay. Next adjustment is for point number 10. Directors to accept settlement of their loans as to 90% thereof by allotment of equity shares, 5% in cash and 5% being waived. So director's loan is what amount? 1 lakh. So this is settled. say loan from directors debited 1 lakh. Against this, 5% is waived, 5% in paid in cash. To bank, 5,000. To capital reduction, 5,000 and 90,000. For this 90,000, they will get equity shares of rupees 2 each. 2 equity share capital, 90,000. Okay. Now, we will close all the accounts, all the remaining accounts which are there in terms of whatever is required to be written off towards that. So patents will be written off. 2 patents, 37,500. Goodwill will be written off, 1,30,000. Inventory will be written off by 65,000. Okay. Provision is required to be created for doubtful debts, 68,500. All right. Then do we have anything else? Yes, do we have anything else? Then the next adjustment is towards capital commitments. There were capital commitments totaling 2,50,000. These contracts are to be cancelled on payment of 5% of contract price as a penalty. Capital commitment doesn't appear in the balance sheet. It's a contingent liability. But out of this, 5% is required to be paid. 5% is required to be paid. So we'll say to bank, 2,50,000 into 5%, 12,500. Okay, yeah. And towards the end, if there is any debit balance of the P&L, that should also get transferred over here. Because it's a debit balance, so we will credit it. So to P&L debit balance. So what's the P&L debit balance? 5,35,000. And all of these will get transferred to capital reduction account. Capital reduction account debit. And what's the amount? 8,48,500. Okay. Clear on this? Any questions? In case you have on this, please let me know before we move on to the balance sheet. Any questions in case you have on this, please let me know. Any questions, any doubts on this? It's simple. Yeah, all of these accounting entries. I think the only confusion which some of you have is about the capital reduction account. So that is very simple. It's just about, you can say, an account in the nature of realization. Okay, and if you remember about realization account also, that was nothing but an account used temporarily for the process to be completed. So when the process gets completed, that account came to an end. So same is the case of this account, capital reduction account. So this will also come to an end. Okay, clear on this? So we move on to the balance sheet now. Okay, Vasudha, Radha, Shubhrat, they are all clear. Shora is saying why the bank account is credited, because the payment has been made towards the contingent liabilities which were not planned, and that's why this account has been debited. So moving on to the balance sheet now. This is A and Company Limited, so we'll have to write balance sheet of A and Company Limited, and you'll have to write this in full balance sheet. Now after this, we will have to use this and reduced. Please remember, you'll have to use this and reduced as at 1 January 2000x2. Okay, yeah. And let's move on to the components of the balance sheet. We will use most of the components of the balance sheet which is there in the question to prepare our structure. So we have first of all equity and liabilities. On this we have shareholders funds. Yeah, and this will have share capital. And we can give the note reference, then the amount. So this can be note number 1. Then we'll have non-current liabilities. Which will comprise of long-term borrowings, because this is also there in the question. This should be note number 2. Then we will have current liabilities. And you can also spare some, leave some space over here whenever you are confused. So let's suppose you may have thought that reserve should come over here. So keep some space. It doesn't matter in the exam. Okay. Vijay Shankar, regarding the partnership, I think we can speak later. Trade payable, short-term provisions. Trade payable, short-term provisions. For the trade payable, there is no note, but for short-term provisions, there is a note. So I'm just also going in line with the solution of the study material. But as I told you, you should try to prepare as many notes as possible. It's always better. And then, of course, the total. Then we move on to assets. So we have non-current assets to start with. On this, we have PPE and intangible assets. PPE, intangible assets. You can give the reference of note once again, 4 and 5. Then we have current assets. Then we have current assets. Inventories, trade receivables. Inventories, trade receivables, cash and cash equivalent. Inventories, trade receivables, cash and cash equivalent. Okay, yeah. And for all of these, you can give the note reference. I'm not giving the note reference, so we'll just move one by one. Fine. So going back to the balance sheet, if you look at trade payables, they will continue. There is no change in this. So 3 lakh I can put over here. On inventories, trade receivables, do we see any change? No. So 4,25,000, 4,80,000. Sorry, inventories have been reduced, but trade receivables have not changed. So this is 4,85,000. Inventories were reduced by 65,000. So 4,25,000 minus 65,000. Okay, so what do we get? 3,60,000. Yeah, for cash and cash equivalent, we will look at the working piece. So now moving on to the notes. So first of all, you should have note number 1, 2. I'm not moving on to note number 1, 2, so on. I'm just moving on to note number 2, please. Yeah, please hold on. I can see some queries from Mukamala. Mukamala, I'll come to your queries. Please hold on. Definitely we'll discuss your queries. Note number 2. And this note number 2 is what? This is long-term borrowings. On the long-term borrowings, now we have got 2 things. The part of debentures which is left. So 3,75,000 minus 1,20,000. So we have got secured 6% debentures, which was what? 3,75,000 minus 1,20,000. So this is 2,55,000. Okay, then we have 8% debentures. For the 8% debentures, what do we have? The new debentures which were issued. That was 1,30,000. That was 1,30,000. So all in all, this is 3,85,000. This we can take over here. Okay. Next is about Aditya is saying note number 1. I'll come to note number 1 later on. I told you. Yeah. So for this note number 3, this is short-term provisions. Now for this, what do we have? Provision for doubtful debts. This is 68,500. So we'll take it over here, 68,500. Okay. So note number 3 is also completed. Now we can move on to note number 4. And that is about PPE. On PPE, we had few adjustments. So the starting amount was, opening amount was freehold property. 4,25,000 was the opening balance, on which there was an appreciation because of reconstruction. So add appreciation due to reconstruction, and that was 82,500, correct? You can always refer the working note over here. Add appreciation 82,500, and then a part of it was given to debenture holders. So we'll say less deductions or disposals. 1,20,000 went to debenture holders. So what was the amount that we got left with? 3,87,500. This is freehold property. Then we also had plant 50,000. A part of it is continuing. No, so full amount is continuing. So plant is 50,000, and there was no adjustment on this. So what do we have? 4,37,500. So we can take this amount over here. Okay. Yeah, we can take this amount over here. Aditya seems to have computed the bank balance. Very good. I will also come to that, but give me some time. So we can now move on to note number 5. Note number 5. That is intangible assets. Intangible assets. Okay. Goodwill is what we started with, and this was written off. Less written. This got nil. Then patents were there, 37,500. There were patents, 37,500, which also got written off. Yeah. All in all, there is no intangible asset in the balance sheet. So this will be nil. This will be nil. Okay. Clear? Moving on to the next note, which we skipped, that was about note number 1, equity share capital. So I'll just clear this part. Yeah? Okay. So now I'll move on to note number 1. Equity share capital or the share capital. Now in share capital there were various adjustments. Let's look at the total amount of share capital that we have now. And this is visible from the entries. So first we have 1,50,000. Then some more shares were issued for payment of preference dividend. So 150 plus 24. So we can say X number of equity shares of rupees 2 each of the above. One note is required to be given. So if you look at the working, so it's 1,50,000 plus 24,000. 1,50,000 plus 24,000. Okay, so I'm talking about the equity share capital issued. Then was there any further issuance? Yes, 90,000 were issued further plus 90,000. So what is the total? Can you give me the total of all of these three? Total of all of these three. Quickly, can you give me the total? Quickly, can you give me the total of all of these three? Yes. 150 plus 24 plus 90. So what do we get? 2,64,000. And every share of is rupees 1 each. So how many shares do we have? 1,32,000. Okay. Now, out of this, if you will see, out of this, if you will see, this amount of 90,000 is gone to directors for their settlement of loan, and 24,000 has been issued to preference shareholders. These two amounts have been issued without cash. So what do we write? Of the above, 57,000 shares have been issued for a consideration other than cash. Okay, they have been issued for a consideration other than cash. Clear? Yeah? All right. So now, what's the next thing? Preference share capital still remains. It's not completely gone on. So we can say on this one, we should write first of all equity share capital. Then we'll write preference share capital. So now, in terms of preference shares, there was reduction, and total amount of preference share capital is 3 lakh. And every share is of 75 each. So how many shares are we left with? 4,000. 4,000, 6% cumulative preference shares of rupees 75 each. Okay. Yeah, those should be 75 each. So this will become 5,64,000. 5,64,000. Clear? Now on this cash and cash equivalent also we can prepare a note, or maybe for our purposes we can get on our working. So I'll just prepare a working note for this cash and cash equivalent. Now this will come from the entries only. So do we have any opening balance of cash? Do we have any balance of cash? No, it's not there. So let's see if there's any cash generated. 22,500 has been given. Okay. Then 1,30,000 was received. Correct. Then 1,40,000 was received. Okay. Then 5,000 was paid to directors. 12,500 was repaid. Minus 5,000 minus 12,500. Okay. Quickly, you can tell me the balance of cash and cash equivalent, please. Now, in the question, if you will see, 1,95,000 is the bank OD. So this will get adjusted over here, 1,95,000. So we can say minus 1,95,000. So can you give me the total of these, please? Can you give me the total of these? Over to you quickly. What will be the total of these? I think in this 2,30,000, which Rupasmita and Chaksham you have given, this 1,95,000 is not adjusted. Can you give me the amount after this, please? Okay, Meghna is saying it's 35,000. Rupasmita is saying it's negative. No, it can't be negative. Huh? So I think it has to be positive. So this is 35,000, but all of you, can you please confirm what's the amount that you are getting? Total of all of these, please. Quickly. Because I'm getting a lot of answers which are different, so that's why if somebody can confirm. Yes, I'm waiting for a response. Quickly. Aditya is saying it's 35,000. So yes, I think it's 35,000. Meghna and Aditya are saying it's 35,000. So this is 35,000. And you can give the reference of working note. So now, if you can give me the total of liabilities and equity and the total of assets, and please confirm if they are matching. Quickly. Can you give me these totals, please? Yes, I'm waiting for your response. Can you give me the totals, please? All of you quickly, what's the total over here? Vasudha is saying it's 1 lakh. Oh, so I think that's the total of this one. 1,95,000 Vasudha, that is because of overdraft. Overdraft is there in the balance sheet. Okay, Magnizing liabilities and equity is 13,17,500. Very good. Aditya is also giving the same response. And what about assets? Vaishnavi, you need to revisit this total. Vasudha has also confirmed this amount. Can you give me the total of assets? All of you, quickly, give me the total of assets. Okay, Sangeeta is also giving this 13,17,500. And I'm assuming this is for equity and liabilities for assets. Quickly, if you can confirm. What's the total? 13,17,500 is towards equity and liability. For assets, Aditya is saying it's same, sir. Thank God. Balance sheet is tallied. Yeah. So it's a sigh of relief whenever you see your balance sheet getting matched. Now I can come to your queries. So I can see some of the queries from Sukanya. So Sukanya is asking, sir, where did this 24,000 come from? This 24,000 was given to preference shareholders. 1 quarter of the preference share dividend. You remember the entry for preference share dividend? This was given to them. Okay. Then I think the other point which Mukamala is asking, sir, how 57,000 is computed? Very simple. Take total of these two. What is total of these two? This is 1,34,000. 1,34,000 is no, sorry. This is not 1,34,000. This is 1,14,000. Yeah, this 1,14,000 is given for consideration other than cash. So this is the total amount. Number of shares is what? Divided by 2. Clear? Vaishnavi has also confirmed the total. Meghna is also getting the same total. Vasudha is also getting the same total. Aditya is saying, I have solved all the illustrations and questions. Those are very easy. Very good. Only illustration 7 is pending, bit confusing. No problem. Aditya is asking, sir, I am completing amalgamation question in 30 to 45 minutes. What is the ideal time for it? I'll get back to you. Vasudha is saying, so the question doesn't speak about issue of 8% debentures. Question says that the loan is received and this is going to the debenture holders. That's why it's been kept as debenture. Okay, Mukamala is asking, sir, please explain this entry capital reduction to equity for 24,000. So it's gone towards the preference share dividend for 1 quarter. Out of 4 years, it's gone for 1 year. So that's the amount. Meghna is asking, what is capital commitment? It's a contingent liability. So you can say a liability which is not certain. So that's why it's kept as a contingent liability, but in the disclosures, not in the balance sheet. So I think I've been able to answer your queries. Yeah. If there's any further question on this, Radha is saying, sir, we can show bank OD separately on the liability side rather than adjusting from cash and cash equivalent. No. So as per the requirements of Schedule 3, you need to go in case that has been considered to be the integral part of this cash and cash equivalent mechanism. Therein you are required to adjust it. Only when this balance will be inactive, only then you will take it to overdraft. Shura is saying what will happen to the balance of capital reduction account if it is negative. So if there is a balance of capital reduction account, now currently if you look at the question, capital reduction is settled, so it became zero. Debit and credit became zero. But by chance, if something is left in that, that will go to capital reserve, and that capital reserve will appear in the balance sheet under reserves and surplus. That's why I told you those notes, huh? Those are the notes you need to remember on this. Clear? Sure on this? Sakshi is clear. Mukmala is saying, sir, please explain 57,000 shares calculated. Please explain this entry capital reduction on blackboard. See this 57,000 shares I just told you. This plus this divided by 2 is 57,000 shares. And capital reduction entry I have already given on blackboard. Yeah. I'm just saying that if you compute the balance of capital reduction, it will be zero. That's it. Currently it's zero. So that's why we don't need to get into that detail unnecessarily. Yeah. Anything else? Any more queries from your side? Okay, no questions? No further questions on this? All right, so let's take a break now for 10 minutes. Let's take a break now for 10 minutes. After the break, we'll continue on this, and we'll also discuss as to what really needs to be started after this, because we are done with this part of internal reconstruction. Maybe we can just look at some more part around it which can be of help to you, and then we'll also start with something different. All right, yeah. So let's meet after the break. Let's take a break of 10 minutes. Hi. So let's continue with our discussion. First of all, moving to your queries. So I see many queries coming from you. Sukanya is asking for dividend areas treatment. I think I talked about it, but let me just repeat it once again. I think same is the query of Mukmala also. If you read point number 2, it says preferred dividend has not been paid for 4 years. So 4 lakh into 6% will be the dividend for 1 year. For 4 years, what will be the amount of dividend? This will be the amount of dividend. Correct? Out of this, question says, out of this, 3/4 has been waived. So this is not appearing anywhere in the balance sheet and not required to be recorded. But 1/4 is required to be adjusted. So what is 1/4 of this? It becomes 24,000. Now when this will be paid, how is this required to be treated? Equity shares of ₹2 each will be issued for this. So we'll say 2 equity share capital, 24,000, and over here capital reduction account debit 24,000. Clear? Yes, Vasudha, please go ahead with your query. Sukanya, I'm hoping you're clear on this. Vijay Shankar is saying we can just take up important and difficult adjustments only, not the whole sum. If you are continuing with this internal reconstruction part, sure. Kamal is asking, sir, why is this P&L account adjusted? Because that's the requirement of this process. Whenever you will have any negative balances of reserves, they will all get adjusted with capital reduction. Okay, Shikha is asking, please explain interest payable on debentures. Interest payable on debentures is given in the balance sheet and that has been paid in cash. As simple as that. Yeah. Now what I am doing is I am just continuing further. And in fact, if you will see, most of the illustrations which will come are same. Okay, there's not really any difference in terms of concept. So conceptually, you will find most of the illustrations to be same. But Aditya pointed out it's illustration number 7, which is troubling him. So by chance, this is the illustration that has come from you. So that's why I can pick up this illustration once again. Look at the part of this illustration, not this illustration completely. Try to get into this concept once again. And that is how we plan to conclude this discussion on internal reconstruction. As a next step, now I need your attention, please. As a next step, we can either go to liquidation or we can start with consolidation. So what I'm thinking is that after we are done with this, we can move on to consolidation, because not much time will be left for liquidation. Anyways, so we'll have to drag it to next session, and every time the schedule will get disturbed. Now, instead of doing that, what we can do is small part of consolidation we can do now. today, means after this internal reconstruction. And after this, we will move on to consolidation. Liquidation we will take to the end, means towards the last part of the sessions, we will take the liquidation. But don't worry about liquidation, so that will also be covered. Okay. So if you have any comments on this, if you have any suggestions on this, please let me know. So this is the plan which I am thinking we can follow. It's over to you. If you have anything over this, quickly let me know. I'm just waiting for your responses on this plan, because it's all of you who are going to be involved in these discussions with me. So quickly, if you can just let me know around this. Sure, I saying illustration number 8. See, all of these are same. There is no difference, as I told you. All of these are same. No differences. Huh? Mukula is asking in note number 1, 45,000 increase has been issued. How we get 45,000 shares? Please explain. Mukula, I think you have not looked at the accounting entries completely. I would request you to please go back to the recording part, because otherwise we'll just end up solving this illustration once again. Huh? Yeah. So I would request you to maybe park your queries related to this part towards the end of the session. Otherwise, we'll not be able to move further. Okay. Yeah. So moving on to illustration number 7 now. This is page number 6.31. Lakshmi is saying, let's go ahead with this. Shuddha is also saying, let's go ahead with this. Okay, very good. Any more suggestions? Radha is saying, yes, with liquidation level. Definitely. So it will be done. It's just that we are parking this towards the end. And after this, we'll be starting with consolidation. Shora is saying, take easy chapters first in which full marks can be scored. See, I can tell you this entire subject is very easy, and in which you can score marks provided you understand the concept clearly. Yes, all of you can just share your suggestions, comments, please. Any more suggestions? Yeah, so after this, we plan to start with consolidation then. Huh? Okay. Yeah, so now moving on to illustration number 7. So we are once again given the balance sheet of ABC as at 31st March 2000X1. So there are some components of the balance sheet which you can see over here. Okay. Then we have the notes. Then there are few points are suggested as per the reconstruction scheme. Let's understand that. Preference shareholders would give up 30% of their capital in exchange for allotment of 11% debentures to them. Debenture holders having charge on plant and machinery would accept plant and machinery in full settlement of their dues. Inventory equivalent to 5 lakh in value will be taken over by trade payables in full settlement of their dues. Investment value should be reduced to marketplace. Company would issue 11% debentures for 3 lakh and augment its working capital requirement after settlement of bank overdraft. You are required to pass journal entries and prepare the balance sheet. So once again, it's easy to do. Very much on the similar lines we discussed. So quickly, still, for our practice, we will look at the journal entries. Balance sheet is something which you need to prepare. And Mukmala, I think many of your queries which have got generated should get resolved with this. So just keep following each and every accounting entry, because many of these accounting entries we have seen over there also. Okay. So the first, preference shareholders. So what is the amount of preference share capital? 6 lakhs. they will give up 30% of their capital. So let's see what is the amount of preference share capital. It's 6 lakhs. So we have journal entries. So we'll say 8% preference share capital debit, 6 lakhs. Yeah. Now they will give up 30%. So 30% is gone. So 70% will be retained. So what is the 70%? 6 lakhs into 70%, 4,20,000. For this 4,20,000, what do they get? Preference shareholders will get 11% debentures. 11% debentures. This is 6 lakhs into 70%. And 2 capital reduction. 2 capital reduction. That is 6 lakhs into 30% which they have lost. 1,80,000. Clear? Yeah? Okay, so now Purnima is requesting, sir, if it's possible, can you work on Excel instead of board and share the screen? It would be very helpful. So I can see different requests coming from all of you. And once again, I would seek your suggestions on this. Do you think working on Excel will be better than the board? So whichever mode you want to follow, we can definitely consider that. Okay, over to you. Quickly, over to you. You can just let me know about this. Then the next adjustment, debenture holders having charge on plant and machinery. What's the amount of debentures? The amount of debentures, 12 lakh. They have charge on plant and machinery, would accept plant and machinery in full settlement of their dues. So the next step will be 9% debentures debited. What's the amount? 12 lakh. So 12 lakh will be closed. Okay. 12 lakh will be closed. And they will get plant and machinery for their settlement. So what's the amount of plant and machinery? 9 lakh. 2 plant and machinery. 9 lakh. And 2 capital reduction. This is 3. Okay. So you can see Shaurya, Aditya, Radha, they are saying keep using board. This is better. And I would request all of you to share your comments. Moini is neutral on this. Moving on to the next adjustment, that is about trade payables. Inventory equivalent to 5 lakh in book value. So it's 14 lakh total. Out of this 5 lakh in book value will be taken over by trade payables in full settlement of their claims. So trade payable is 5,92,000. Trade payable 5,92,000. They will get inventory. Inventory equivalent to 5 lakh. 2 capital reduction 90 2,000. Okay. Number 4, investments have investment value to be reduced to market price. Investment value should be reduced to market price. So that means a provision is required to be created there in will pocket. Company would issue 11% debentures for 3 lakh. So new issue will come for debentures for 3 lakh. So bank debit to debentures 11%, 3 lakh. Okay. Next, company would augment its working capital requirement after settlement of bank OD. So that means bank OD has to come to an end. So what is bank OD? 1,50,000. That will be paid. Bank OD debit to bank. 1,50,000, 1,50,000. Clear? Yeah. And next step will be about transfer of investment value in terms of bringing it to its market value. So market value of the investment is 55. So needs to be cut down. Two investments. 68,000 minus 55,000. 13,000 will be the reduction. Okay. P&L has got debit balance, so that will come over here. To P&L debit balance 4,05,000. Correct. 4,05,000. And then these two amounts will also get transferred to capital reduction account. Capital reduction account debit. So this is 4,18,000. Okay. Now in this case, because our accounting entries are completed, so that's why we should check, is there any balance left in the capital reduction account? So let's see. Capital reduction was having a credit balance of 180. So you can say minus 1,80,000. Then minus 3 lakh, minus 92,000, minus 3 lakh, minus 92,000. Minus 92,000. And then we had positive amount, means the debit balance. These are all credit. And then we had 4,18,000 as the debit balance. So can you give me the total of this? This is 1,80,000. Can you give me the total of this quickly? So it's all about preparing the account of capital reduction. Quickly, can you give me the total of these, please? Quickly. Pooja, in terms of investments, those have been cut down to the market value. So in the books, they are appearing at 68. It's been cut to 55. Simple. Devendra, Pooja, Amit, they're all saying let's continue with board. Vijay Shankar is saying, what if the P&L will have credit balance? This process of restructuring will not start then. And now I'm waiting for a response. Can you please quickly compute this? Radha is saying, sir, this should be 1,54,000. And this is credit balance or debit balance? Radha, this is credit or debit? Credit. This is credit balance. So we are left with something in capital reduction account. What do we do with this? We will debit it once again. Capital reduction account debit 1,54,000. The balance of this will be transferred to capital reserve 1,54,000. And this capital reserve will go to the balance sheet under reserves and surplus. Okay. Clear, simple, easy to do. Simple, huh? Easy to do. All of you clear on this part? Yeah, just give me 1 minute, huh? Okay, so any questions, any doubts in case you have on this? No? So with this, we can conclude our discussion on internal reconstruction, and we can now move on to the discussion on consolidation. All right. Nakul is asking, sir, where to transfer debit balance of capital reduction? See, this will not have a debit balance. Please understand this. These schemes are such that some of these questions you are asking will not be possible there. Okay, practically you will not see such balances coming in. Okay, you will not see that coming in. Rather, it's one and the same thing. You should practice that. I don't see that to be different. Aditya, as I told you, liquidation is something which we pass to the end. We will pass back to end. So we will now start with consolidation. Okay, so all of you, if you can just move on to this part of the study material. I think we need to move into the next module. Rama is saying, sir, when we are going to discuss the liquidation. As I told you, at the end means the last sessions will be covering this part. Isha is asking, sir, after examining the question, how to know that capital reduction account is to be used? So you're saying in the examination question. So in the examination question, you will have this information of internal restructuring. See, in the questions, if you'll see, it talks about internal restructuring has taken place. Court has approved a scheme, and that's why you will get to know about it. Okay. So I think doubts of Mukhamala are also cleared. So do we move on to the next part then? Yeah, Rama has noted this. All of you please note that liquidation we will cover, but the last sessions that we will have will be towards this liquidation. So I'm just sort of allocating this to the last sessions instead of just picking it up now. Otherwise, what will happen is every session will have this disturbance in terms of the topics which are allocated and the one that will be covered. Okay, that's the only reason of doing this. Otherwise, there is no particular reason because next session is allocated to consolidation. So again, a lot of queries will come in. Sir, why we are not starting this? So that's why. This is because of the backlog which has been created, but will sort out and towards the end. Okay, now moving on to consolidation. As around consolidation, I think the most important aspect that we need to understand is about the meaning of consolidation, the requirements of consolidation, and when would it arise. So basically, it's about a group. It's about a group wherein, let's suppose A is the parent, or you can say is the holding company, and below this, say we have S1, S2, S3 as its subsidiaries. So these are the subsidiaries. Okay. These are the subsidiaries that we have. Now, as per the requirements of the Companies Act, consolidation is mandatory whenever an entity has got subsidiaries. For our purposes at your level, we don't need to get into a situation wherein a company may have associates or joint ventures. It's only limited to consolidation of subsidiaries. So that's why we'll always be talking about subsidiaries. Otherwise, consolidation also requires inclusion of those two types of companies. Okay. Next, and the most important principle. See, if you have to understand consolidation, now this would be the most important part. So the basic premise on which this consolidation is based is considering this entire group as single economic entity. Single economic entity. When the consolidated financial statements of the group would be prepared, it would mean financial statements of A, S1, S2, S3 will be added together, added on line by line basis, wherein after their addition, one line will remain, or you can say one column will remain, and therefore what you should think, what you should consider is that these are not really the four different companies for the purposes of group consolidation. This is basically considered as if it's one single economic entity. Means all of these are actually comprising of one entity. Because if we follow that, that will include all of these companies at one place, and our consideration should also be such wherein we are not thinking of all of them as different, rather as one entity. Okay, clear? Now, as around this consolidation, before we get on to some more principles, some of the terms you'll have to remember that for the parent, we use the term holding company also, and subsidiary will become a subsidiary of the parent only when parent or the holding company would have control over the subsidiaries. Now, what is this control? Again, this criteria is available. We don't need to get into this control assessment. That is something with which we'll start. So you will not have to ascertain whether there is control or not. We'll have to check that control exists. The moment there is a control of parent over the subsidiaries or over these entities, they will become subsidiaries and the consolidation will be required. That will be mandatory. Now, as per the requirements of Companies Act, as we have discussed, consolidation is mandatory. However, in one situation, an exemption may be given from preparation of consolidated financial statements. So let's try to understand that exemption. And I'm talking about the requirements of Companies Act. I'm not talking about accounting standard right now. So we can understand this with the help of an example. And if you want to refer it in the study material, so you can go to page number 10.6. This is exemption from preparation of CFS. So let's say this is A. A has got 100% interest in B. B has got 100% interest in C. And C has got, say, another subsidiary, D. Okay. It's 100% because I want to be in control. It can be less than 100% also. So it's not necessary that it has to be 100%. It may be less than 100%. It may be less than 100%. It may also be less than 100%. Clear? Now, for C, consolidation of B is mandatory. For B, consolidation of C is mandatory. Of course, that will include consolidated financial statements of C. For A, consolidation of B is mandatory, which will mean consolidated financial statements of B for A. Now, we are trying to look at one exemption in which C may be exempt from preparing CFS. Means CFS, consolidated financial statements for C would not be required. So that's a situation. For this, what's the first condition? C should either be wholly owned subsidiary or partly owned subsidiary. Wholly owned means 100% shares are held by B. Partly owned means 80% shares are held by B. Okay. And its shareholders, its owners do not have objection if C doesn't prepare CFS. Okay. So no objections from the owner. Condition number 2. C should not be listed and should also not be in the process of getting listed. So it should be unlisted. It should neither be listed nor in the process of getting listed. Okay. Vijay Shankar is saying, sir, whether consolidation includes subsidiary? Of course, yes, you can see this. Condition number 3. Either the intermediate holding of C Who is the intermediate holding? B. Or we can say immediate holding company, B. Or you can say holding company of C, that is B. Or the ultimate holding company. For C, ultimate holding company is who? A. Ultimate holding company. This is A. Correct? For C, ultimate holding company is A. Correct? So either B or A should be preparing their consolidated financial statements, and those would also be filed with the registrar of companies. So either A or B prepare CFS, and that is with registrar of companies. In case all these conditions are fulfilled, that means this plus this plus this plus this. When all of these conditions are fulfilled, in such a case, if C wants, now it's an option, if C wants, it may not prepare its consolidated financial statements. Clear? Yeah? It's a choice of exemption available to C, which it can consider. Okay, clear on this? Yeah? Now moving further on to the requirements of accounting standard number 21. So far, some of these points related to consolidation that we discussed were arising from the requirements of Companies Act 2013. Okay, some of these requirements were arising from Companies Act 2013. Now, we will not be limited to this this requirement, because we also see an accounting standard. Accounting standard number 21. For the purposes of accounting, what do we need? We need to refer accounting standards. And for the purposes of consolidation, accounting of consolidation, we need to refer accounting standard 20. Okay. Now in this case, one thing which you need to understand is that accounting standard doesn't say when is this consolidation required to be done. See, if we have A and below A we have P and Q, and both of them are subsidiaries. Now in this case, preparation of CFS of the group means consolidated financial statements of A is not mandated by accounting standard. Accounting standard is not requiring you to prepare CFS. Where is this requirement coming from? Companies Act. It may come from somewhere else. Accounting standard is not asking you to prepare CFS. But in case the CFS will be prepared, wherever that requirement comes from, and those requirements are required to be fulfilled as per accounting standards, in such a case, AS 21 will have to be followed for the guidance. Means if the consolidation will be done, it has to be as per AS 21. But AS 21 doesn't ask you to prepare CFS. It only guides you how to prepare CFS. Means, when is this consolidation required? This is not answered by case 21. How is this consolidation required? This is the one which has been answered by AS21. Or you will go to AS21 not to check when the consolidation is required, but to check how the consolidation will be done. Clear? Now further on to this, we discussed that there is one exemption wherein holding company may not prepare CFS, and that comes from Companies Act 2013. Accounting standard number 21 also gives you a couple of exemptions. But this is not the exemption from preparing CFS. Accounting standard number 21 says that two types of subsidiaries will not be consolidated. It just simply says that whenever the consolidation will be done, two types of subsidiaries will be excluded from consolidation. So let's understand what are those two types of subsidiaries. Subsidiaries excluded from CFS. Two types of subsidiaries are excluded. So Shore is saying, sir, we studied the exemption of not preparing the CFS under law, in law. Very good. So I'm hoping that you got the clarity over there. Yeah, so it's a sort of revision for all of you. Yeah, that's correct. Okay, now coming back to this. Now, which are those types of subsidiaries which will not be consolidated? Let's understand. First, when the control in subsidiary is temporary. Why? Because this is held for disposal. Because this is held for disposal in near future. When the control in the subsidiary is temporary, why? Because the investment in such subsidiary is temporary. Okay. In such a case, subsidiary will not be consolidated. Number two, when the subsidiary operates under severe long-term restrictions. When the subsidiary operates under severe long-term restrictions, because of which its ability to transfer funds to the parent is significantly impaired. Transfer of funds to parent is significantly impaired. Ability to transfer the funds to the parent is significantly impaired. So these are the two conditions, or you can, these are the two situations, or you can say two types of subsidiaries which will not be consolidated. Okay, any questions? in case you have on the discussion that we have had so far, please let me know. Any questions, any doubts on the discussions that we have had so far, please let me know. Quickly. Mukmala is saying, what's the meaning of temporary? Temporary means it's held for sale in near future. So even though we have got control in subsidiary, it will not remain permanent. It will be temporary in nature. Very soon subsidiary will be sold, means we will sell that inventory. The investment in that, we'll sell that subsidiary. The investment in that subsidiary will be sold very soon. That's the point. Okay. Any more questions? Any more doubts in case you have on this? So let's move further then. There are few terms which we need to understand before we move further now. First is the meaning of wholly owned subsidiary and partly owned subsidiary. Say A has got investments in X and Y. 80% is the shareholding in X and 100% is the shareholding in Y. So Y will be called as wholly owned subsidiary and X will be called as partly owned subsidiary. Now if you look at X, 80% shares of X are held by A. A is the parent, but 20% of its shares, let's suppose, are held by B. 20% of its shares, let's suppose, are held by B. B is not the parent. Why? Because A has got control over X. A has got control over X through 80%. So in this case, B will be called as shareholder of, but it's a minority interest holder. The interest of B is what? That of minority. It's a minority interest holder. Clear? So this B is having 20% shareholding, but B will be called as minority interest. Okay? Clear? Yeah. Now moving further onto the requirements related to consolidation procedures. So what all of you can do is, you can please move on to page number 10.13. Page number 10.13. And before we move on to the next part, you should write your homework. Homework is to practice questions of internal reconstruction. Number 1. Number 2. Read the procedures of consolidation given on para number 9 and 10. Please understand that I am only asking you to read. You will not get into the understanding of the concept if you don't read this. Okay, we will have a discussion on all of these things, but its reading is important for us. So read section number 9 and 10 of CFS starting from page number 10.1. These are two different chapters. And for this, I am only asking you to read. Please note down this homework. And now I will move on to the consolidation requirements. Meghna is asking, sir, up to what percentage minority interest will continue? So there is no specified percentage. It can continue up to 49%. Okay, but in the exam, don't worry about it. You will get to know this. Okay. Okay, now let's understand some of the principles of consolidation. So I'll just clear this part of the homework now. Let's understand how is the consolidation required to be done. Say we have holding, and below holding we have got two subsidiaries, S and P. Okay. Now in this case, for the purposes of consolidation, accounting policies of holding, S and P should be similar. So the accounting policies of the group should be aligned. Should be aligned. How will this consolidation take place? Let's understand. We will start with the financial statements of H. So let's suppose it has got assets, liabilities, P&L. Okay, this is effectively the trial balance. So this is of H. Then for S, it will come. Then for P, it will come. Then we take a total of 1. What is total? H plus S plus P. H plus S plus P. Okay. Now this consolidation is what? This is nothing but line by line addition of every component of the balance sheet and P&L, except certain components which we'll discuss. Now from these components, certain adjustments are made, certain eliminations are made, which are called as consolidation adjustments. So let's understand what can those consolidation adjustments be. H will show investment over here, and H will have investment in S. Correct? H will have investment in S. So let's suppose this is investment in S. If you look at the liability side, S will have share capital, and share capital of S will be what? This. Now, when these are taken to the final consolidated number, what is required to be done? These two will be eliminated. These two will be eliminated. Second, it may happen that during the year, these group companies may have transacted with each other. Say, H has given a loan to P. P has been paying interest to H. Secondly, S might have sold goods to P and those goods are lying with P. Correct? Please understand the basic premise that we discussed, that consolidated financial statements are prepared as if these are not three separate entities but one single economic entity. Therefore, if there are any transactions between any of them, what is required to be done? Elimination. Elimination of intra-group transactions or balances. What is intra-group? Transactions within the group amongst these three entities. That's the second thing which you have to consider always when the consolidated financial statements are being prepared. Clear? So two things we have discussed. Third will be about computation of goodwill or capital reserve. Now, this is not something which is new to all of you. Under amalgamation, we have considered this. Why? Because when an entity is acquired by another entity, what do we achieve? We achieve control at times. And whenever the control is achieved, what do we prepare? CFS. But on the date when the control is acquired, goodwill will have to be computed or capital reserve will have to be computed. How do we compute that? We already know that. Yeah. And on this date, another computation will arise. That will be of minority interest. Now let's try to understand what is this adjustment of minority interest. We will get into the details of all of them in the next session. I am just touching upon it. Now, H is preparing its CFS and H has taken up everything of S and P. But let's suppose H holds 80% of S and 60% of P. Now, in this case, 20% of S belongs to whom? Minority. 40% of P belongs to whom? Minority. Currently, in this line by line addition, everything related to minority has been added. H has included everything related to both the subsidiaries in its consolidated financial statement. But is this 100% belonging to H? No. So that's why for the part which doesn't belong to H or the parent company, an adjustment will have to be made to show in the CFS that even though we have added everything over here, this much part doesn't belong to us. This much part belongs to minority shareholders. Okay, and we'll discuss when we'll prepare the balance sheet, when we'll get onto these computations, we'll discuss all of these points. And that's why I suggested that please read these procedures which are given on page number 10.13. Even if you don't understand that, it's okay. Just read that. Okay. This section number 9 and 10. Just make sure you read that. Only a simple reading will be sufficient. Okay. Clear? So with this, we can end our discussion for today. In the next session, we will continue with our discussion on consolidated financial statements. Please understand that this chapter is very, very important. Yeah, very, very important. That's why you should make sure that whatever we have discussed today, you revise before we meet. All right. So thanks to all of you once again for your time and for your wonderful participation. Thanks so much.